the last year, most of the domestic pharma and biotech stocks that have been, you know what, they've been dead money, right? Investors are paralyzed by fears of lawsuits. Oh, tell me about it. The potential for new legislation that might crack down on drug pricing. In fact, it's been going on even longer than that. Over the past 4 years, the whole group, as measured by the IBB, iShares, NASDAQ, Biotech ETF, and the Invesco Dynamics Pharma ETF. Can you believe this is what they've created, and this all does matter? Well, it's been hammered. Biotech down 4%, Pharma down 19%. Well, the S&P 500 is up 53% over the same period. You know, I run a charitable trust, ActionAlertsPlus.com. We try to be diversified, but every time we try to do pharma, it's been terrible. So what should you do? What should you do? Should you completely abandon the drug stocks? Get your healthcare exposure from less precarious parts of the sector? I mean, like the medical device makers, they're doing better. No. You don't need to give up on the whole complex, right? But you do need to get more selective and more creative with these stocks. For example, last Friday, I told you to keep an eye on AbbVie. I said I liked it because of its process of acquiring Allergan. I'm betting that deal has a lot of potential. Did you notice that AbbVie was up more than 3% this week, thanks to a fresh upgrade from Citi yesterday, and it was a really good piece. And now I've got another way to approach this group, because I've been mulling over and with Ben Stoto, mulling over. I said, I got to find a way to give people farm exposure with less risk. If the domestic drug stocks aren't working, how about this? How about the foreign drug stocks? As it turns out, many of the foreign pharmaceutical names are performing a lot better than domestic peers. The three that jump out at me that we're going to talk about right now are AstraZeneca, GlaxoSmithKline, and Novartis. Now, I think some of that may be because they have moderately less U.S. exposure than their American counterparts. So something like a Medicare for all or even price controls on drugs would hurt them a little less. I'm not saying they have no exposure, but I'm not saying they have more exposure. It's just a little better. But when it comes to these three companies in particular, they've each got something going for them right now that allows them to throw off the gravitational pull of the pharmaceutical sector and allows them to rally. All right, let's start with AstraZeneca, which I haven't thought about for years because it was such a dog. All right, this is a big British pharma company. If you're worried about developments in the United States, AstraZeneca gets less than 33% of its sales from here. That's substantially lower than most American drug companies. And if Elizabeth Warren wins the presidency in a landslide, allowing her to implement a single-payer healthcare system, a lot of investors are betting that European companies like this one, AstraZeneca, will have more expertise at dealing with it than their American rivals. Now, that might be a stretch. All the big pharma companies are global operators. But something like AstraZeneca has marginally less exposure to America and marginally more experience navigating healthcare systems that have price controls or single payer. Now, earlier this month, JP Morgan hosted a conference call with Pascal Soriot. He's AstraZeneca's CEO, where he laid out the bull case for his company. I found it very compelling. It goes like this. They've had a bunch of positive clinical trial results that will allow them to launch some potential huge new products or expand existing products into the new markets. Now, you're going to have to forgive me because I'm about to go into the world of pharma mumbo jumbo. They've got Tagrisso. That's a treatment for non-small cell lung cancer. They're negotiating reimbursement rates with China on this one. And if all goes well, it could be very lucrative. Unfortunately, China has horrendous numbers of people with this disease. Then there's Imfinzi, which is a monoclonal antibody drug that's also used for lung cancer, where they're expecting some label expansion. Right now, it's only approved for use after chemoradiation. You've got Lynparza. That's an ovarian cancer drug that could work also for prostate cancer. AstraZeneca's also got Farxiga, which helps low blood sugar levels in patients with type 2 diabetes, also being studied for heart failure and chronic kidney disease. Look at this, some lineup, huh? Oh, and they've got Calquence. This is a mantle cell lymphoma treatment. They recently received breakthrough therapy designation from the FDA and other really terrific data. On top of all that, AstraZeneca has some late-stage pipeline candidates that could have enormous potential, like roxadustat for people with anemia caused by chronic kidney disease, or anifrolumab for lupus and other anti-immune conditions. Meanwhile, as sales for these incredible drugs ramp, AstraZeneca's gotten aggressive about keeping its costs in line, and management sees their margins going higher. After years of investing in its pipeline, those moves are finally paying off, hence why the stock's up 19% year to date. I think AstraZeneca is a touch too expensive. I remember it used to have an 8 multiple. Now it's got 22.5. But it's got 3.1% dividend yield, which makes the pill easier to swallow. And can I just say that I remember meeting with management years ago, and they kept telling me they were going to have all these great cancer drugs, but it takes so long to develop them. Well, guess what? They're here. Next, there's GlaxoSmithKline. That's another gigantic British drug company. Gets just 39% of its sales from the U.S. I've been a fan of this one ever since we sat down with Glaxo's new CEO, Emma Walmsley, at the beginning of the year when we were at the J.P. Morgan Healthcare Conference. Walmsley has a brilliant plan to transform GlaxoSmithKline. She's been divesting Glaxo's more commoditized businesses and investing heavily in fast-growing new areas like oncology. For example, back in December, they bought Tesaro. That's a biotech focus on cancer. For $5.1 billion, and they agreed to spin off their consumer products division and merge it with Pfizer's. At the moment, Glaxo is stuck in kind of an in-between state, a transition year, as it works to complete these major deals. Or at least that's how it looked a few months ago. But then the company reported a better-than-expected quarter in late July, dramatically raising its full-year earnings forecast. Plus, Glaxo has at least 5 high-profile drugs in phase 3 trials that could potentially become blockbusters over the next few years. Put it all together, and I'm even more bullish about GlaxoSmithKline than I was in January when I was kind of blown away. I said, holy cow, why am I overlooking this one? This Glaxo's got a lot going for it. Oh, and with the stock selling for less than 14 times earnings, I'm calling it a steal. Plus, Walmsley's paying you to wait 4.8% yield. That's a good investment. Finally, how about one my charitable trust isn't buying? We talk about it for the club, fractionalistplus.com. Novartis. It's the gigantic Swiss drug maker with only 34% exposure to the American market. Okay, just like Glaxo, Novartis is trying to transform itself. Under the leadership of CEO Vas Narasimhan, the company has shed its consumer businesses, even spinning off its over-the-counter eye care business as Alcon in April. We told you we liked that one. At the same time, Novartis has been snapping up smaller companies that are pioneering new technologies, like Avexis. That's a gene therapy play they bought for nearly $9 billion. Now, in July, the company delivered much better than expected numbers. 8% sales growth on a constant currency basis. Core earnings per share up 20%. These numbers trounced Wall Street's estimates, thanks to the strength in Novartis' psoriasis, heart failure, and oncology franchises. On top of that, Novartis also had some big product launches coming up, including a major breast cancer treatment. Now, there is one fly in the ointment that I think is holding the stock back. Last month, the FDA rebuked Novartis for failing to disclose that the newly acquired Avexis had been manipulating data on its big new gene therapy. Novartis has denied all wrongdoing. They've already fired everyone who was involved, and it sure seems like this gene therapy is still very much on track to be approved. But this was still an ugly headline. While I don't like it, it's not a deal breaker for me. It might be for you. I trust Vas to do the right thing. You may not. But I don't know. We have to just go with our guts here. Fortunately, those not-so-hot headlines mean you can buy Novartis at a discount here. Stock trading at 15 times earnings, sporting a 3.2% yield. That's why we picked up some Novartis earlier this month for the trust. And you can follow along if you're worried about the lawsuit. We're following it very closely by joining the ActionAlertsPlus.com club, and we're sending out bulletins regularly about where Novartis is with this problem. Here's the bottom line. If you want big pharma exposure with fewer headaches related to U.S. politics, you could always buy a well-run foreign drug company. These are all three are terrific. AstraZeneca, GlaxoSmithKline, and Novartis. All three buys. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.